Welcome back to Insights Unlocked. I'm thrilled to chat this week with CFA charter holder Monica Erickson. She's the head of investment grade corporate credit and a portfolio manager at DoubleLine Capital, one of the fastest growing and most prominent investment firms in the US. In addition, Monica is a huge proponent of diversification in the financial industry and is one of the founders of the Bloomberg Women's Buy-Side Network. She's also on the educational committee of 100 Women in Finance. Both organizations provide education and community to women who are building out their careers in finance. Monica joins me today to shed light on the current dynamics and future outlook within the U.S. investment-grade credit market. Hope you all enjoy this insightful chat. Really appreciate you joining me today, Monica. I hope you've been well.
Thank you for having me. I'm excited to do this. And I have to say, we both went to USC, and I was very impressed with you as a student there reaching out to me. You've reminded me a little bit of myself, 30 years ago.
Thanks so much for that. It means a lot. Before we kind of dig into corporate credit dynamics, I think it would be helpful to give a brief overview of your background for listeners who may not know you already. And so could you kind of shine some light into your career path from Froley Revy and TCW prior to DoubleLine, along with your current role at DoubleLine today?
Yeah, sure. Absolutely. Well, as you know, you and I both went to USC, and that was really where my path into finance started. I had a couple of really great professors there that really led me down the path of specifically finance and investments as opposed to something broader in business. And when I was doing some work at USC, one of the classes we did we had a project where we could basically do anything we wanted related to picking securities. And I chose to do a project looking at 4 different factors. And it was back when we didn't have really strong computers. So I think I did it on my Quattro Pro, and I did some backdating and figured out that I came up with this 4-factor model that had a pretty good predictability for future equity returns. And there was an investor, George Froley, who knew about this. And that's how I started at Froley Revy. He offered me an internship during my rising senior year. And then his partner, Andrea Revy prior, offered me a full-time job. And it really came about because of this model that I had done at USC and because of the work that I was doing there. So I started at, like you mentioned, at the shop Froley Revy. It was a convertible asset manager. And I was there for about 15 years. And my role there was as an analyst, and I covered a bunch of different sectors. And it was a really interesting place to start because convertibles have aspects of equity, they have aspects of bonds, and then you also have to understand the derivative component of it. So it was a great place to learn. And I grew up there in the 90s looking at a lot of tech names. The internet was funded, a lot of telecom. So as a young person in the industry, it was a super exciting place to start. And then I transitioned from there into investment grade corporates at TCW. I was there also as an analyst for several years. And then there was a group of us that decided to leave with Jeffrey Gunlock in December of 2009 to start DoubleLine. And I transitioned at that time. And again, I was an analyst when I started at DoubleLine, and we were a small firm and there was a lot of opportunity. And I would say that as a firm, we are still relatively small compared to some of the behemoths out there. We have about 280 employees, and we have a very entrepreneurial spirit and a very flat organizational structure. So while I started there as an analyst, there was a lot of opportunity for me to grow. And I eventually grew into the role of portfolio manager and then into managing the investment grade corporate team.
Awesome. Sounds like it's been an amazing journey so far. And so now moving on to the market and the meat on the bone, I think a lot has happened since we last spoke, and so I think it would be helpful to kind of recap the events that have driven investment grade credit over the past year on a higher level. And so LQD, the investment grade corporate bond ETF, is now down about 23% year to date, and now trading below 2020 pandemic lows. And we've also seen over $114 billion of outflows from investment grade funds year to date. And so, in your view, what have been the main factors driving the market right now? And how have things like duration, convexity, and credit risk evolved as this year has unfolded?
Yeah, well, that's it. It has been the worst year in fixed income. I think Deutsche Bank did a study back into the 1800s. So we have never had a year where total return has been this bad.
Wow.
It has primarily been driven from the move in the treasury market. We started from incredibly low rates. I think, the front end was offering 1 or 2 basis points. The 30-year has just gotten crushed. I think the 30-year treasury is down something like 35%. The
Right.
long end of the credit market is down 28%. And if you look at what's really driven it, it has been the move in the treasury market. About 75% of the price action in investment grade corporates specifically has come from the moves in the treasury market, with yields going up, prices going down. The other 25% has been driven by spreads widening out. We also started the year with spreads at fairly tight levels. The index that I look at is the Bloomberg Credit Index, and that index started the year at 87 basis points over, so fairly tight. The
Mhm.
average is the long-term average there is call it somewhere around 120 basis points over. So well below what the long-term average would give you there. We are now at 137 basis points over the equivalent treasury on that benchmark. So a 50 basis point move there. But back to this idea, this movement in the treasury market, the yield to worst, which includes the spread and the treasury yield. So the all-in yield has moved dramatically in the investment grade corporate market. We started the year with a yield of 2.25. And as of today, we're yielding over 5.5%. So that is really where the pain has come from. And historically, what we've seen in that type of a market is you get an inverse relationship with spreads and with treasury yields. And this year, we've seen the exact opposite, where treasury rates have gone up and spreads have gone up. So it's been a double whammy in terms of returns. Now, you asked a couple of questions about convexity and duration. The investment grade market specifically has a high degree of sensitivity to move in interest rates, i.e., it has a fairly, or at least started the year with a fairly long duration. It is the
Right.
longest duration asset class in the Bloomberg Ag. And we started the year with a duration of over 7.5. We're down to 6.5 just because of the move in the market.
Okay.
But a lot of exposure to the move in the treasury market. So that is really why investment grade corporates in particular have gotten hit so badly. And then if you look at other types of markets and credit like high yield, they've actually done better, even though spreads are out more, because they had less duration, i.e., the sensitivity to the move in the treasury market.
Very intriguing. Awesome. So let's talk a bit more about the factor of rates, right? And so rates have obviously been at the forefront driving the market, and the market was seemingly unprepared for Chair Powell's resolute hawkish warning at Jackson Hole. And so we've seen US interest rates rise at an extremely rapid pace, and in fact, this is the fastest rise in global interest rates in 30 years according to Fitch. But despite a lot of the deep recessionary crash narratives that are, spreading throughout social media this year, rate hikes haven't seemed to hit corporates and earnings as hard as many may have expected, at least not yet. And so we saw some bits of light at the end of the tunnel in Q2, anchored by a huge 3x oversubscription for Meta's first bond sale. And so first, I think it would be useful to establish why corporates are holding up relatively well. And so I'm wondering, in your view, is this mainly attributable to corporates pushing out maturities during the low rate environment over the past 2 years, or are there other factors at play here as well?
Well, I think there's a few things. I think that the way corporates have structured their balance sheets over the last, call it 3 years, really since COVID started in March of 2020, corporations have been fairly conservative, I would say, with their balance sheets, right? I mean, I think
Okay.
the scare that took place in March of 2020 really put corporate and treasurers really in particular more on a defensive mode. So what we've seen there is, to your point, there has been, even prior to that, an extension of maturity. So there isn't this concern that there's some big maturity wall out there where
Right.
companies need to refinance. But also, I think there has been a pullback in terms of M&A, in terms of bigger payouts with dividends,
Mm.
share buybacks, those types of activities that bondholders tend not to like, that benefit the equity holders at the expense of the bondholders. So I think companies have been more conservative on that front. And then we're also coming off of an incredibly strong earnings period from the depths of what we saw in 2020. Last year was extremely strong, and this year has been fairly strong as well. One of the factors contributing to the strength this year, frankly, has just been the inflation picture, right? So
Right.
if you look at nominal top line growth and nominal earnings growth, it actually looks pretty good. Companies have been fairly good at passing along their higher input costs, but on a real basis, it's probably flat or possibly negative. But if you're looking at it in terms of credit, you've got your fixed debt, and it is what it is. So in an inflationary environment like we're in right now, it's actually good to have debt on your balance sheet.
Right.
Your debt stays the same and your nominal cash flows increase. So if you look at just general metrics overall on the benchmark, we improved dramatically through 2021, and we've kind of plateaued right now. And we're definitely not at any kind of extreme levels. We're just kind of middle of the road in terms of there are a couple of standard metrics that investors in my space look at. For example, absolute debt to cash flow, or EBITDA. Those
Mhm.
levels are hovering around 3 times, which is a fairly kind of average leverage number. And then interest coverage, in terms of what companies are creating in terms of their cash flow to cover interest, is still at extremely high levels, because companies have financed their debt at these very low coupons. So interest coverage is somewhere around 20 times, where prior it's much higher than it has been prior. And prior, call it like in the 90s and 2000s, it was closer to 5 or 6 times, because interest rates were much higher at that point and companies had financed at those higher rates. So if you look at kind of the overall health of the corporate environment right now, I would say it's neutral. We are starting to see some signs of a slowdown, and there have been companies that have come out and lowered guidance. So you're starting to see definitely companies come out and say that they're feeling the impacts of what the Fed is doing, i.e., raising rates, slowing the economy, and starting to see some slowdown there. So I don't think it's all roses, but I think when you look on the aggregate, the market itself looks, I would say, neutral in terms of kind of fundamentals.
Gotcha. That makes a lot of sense. And so I also want to get some of your insights into the outlook here moving forward, as we have quite a few moving pieces at play. And so inflation is at elevated levels compared to other cycles. There's no denying that, with headline CPI at 8.3% in August, which is up 0.1% month over month, while core CPI has actually increased 0.6% month over month. And so this suggests that the Fed put or Fed pivot is still much farther out this time around until they can really get these dynamics under control. But while inflation and other geopolitical events are affecting economic growth, there seems to be a divergence between economic growth and consumer health, as employment levels are still comfortably strong, while consumer balance sheets are maintaining high levels of saving and moderate amounts of leverage. And so there doesn't seem to really be a clear path of how this cycle plays out. And so therefore, I'm wondering what you're expecting in terms of the next 12 to 24 months within corporate credit.
Yeah, that's a good question. And I think, a lot of it has to do with the path that the Fed takes. And I think the Fed has been very clear in that their primary goal right now is killing inflation. And I think, our kind of baseline is that the Fed will end up doing more than they need to. I think our founder and CIO, Jeffrey Gundlach, has been
Mhm.
very verbal out there discussing about Fed policy, and that, Fed policy acts with a lag. We
Right,
had this massive liquidity input into the system over the last year and a half that really drove, frankly, since March of 2020, that really drove the excess that we have in our economy right now and drove inflation. So there was so much liquidity put into the system. Now, the exact opposite is happening, where liquidity is being taken out of the system with higher interest rates and at a incredibly fast and furious pace, right? Where you're getting 75 basis point increases at meetings.
right,
Um, and the expectation is for that to continue. And like I said, policy takes a while to go through the system. So, our base case would be that if the Fed were to wait and let policy take place, let the economy naturally slow, we could see ourselves in a fairly mild recession next year. But our base case is that the Fed is going to continue on their path. I think that's really what they've messaged to the public. And I think they will continue. And if they continue raising rates at this point, I think the probability of us going into a much deeper recession next year is higher. And
mhm,
Jeffrey was on CNBC I think it was last week or 2 weeks ago, right after the Fed raised rates another 75 basis points, talking about a possibility of a 75% possibility of a fairly deep recession next year. So, if we do go into a recession next year, I think credit will um, be wider than it is today. I mean, credit spreads right now are not reflecting a recession. I would say argue that credit spreads at call it 140 over reflect a slowdown in some weakness, but not a recession. I would think credit
right.
spreads would be closer to kind of the 200 to 20 level if we do go into a recession. And I
Okay,
think there will still be credits that do well in that environment, and there will be credits that do worse in that environment. And then as active managers, that's really our role, is to have a macro view. And our macro view right now is that we are going to go into a slowdown, and the probability of a recession is higher than normal. So we would look for credits that would do better in that type of environment. That's how we would manage through this. But I think, overall, we would expect spreads to be wider. One other thing I would note, having said that, we could see a rally in the Treasury market on the long end, if we do have a recession, or if we do have a prolonged slowdown. yields on the 30-year, 20-year could definitely rally from here. The other point that we've been discussing with investors recently is that what we started with this discussion, we're now at a point where all-in yields are looking really attractive. You've got an all-in
Hmm.
yield in the investment grade market that's the highest it's been in 13 years. So, your starting point is much better than you've had over the last 13 years. So while you might get some spread widening, you might also get a rally on the treasury, which would counterbalance that spread widening. And you're also starting from a point where you are actually getting some yield. So all in all, we're probably neutral, I would say, on credit in the kind of intermediate term. But over the longer term, we're actually positive because we are starting from this higher yielding place, and we will eventually get through a recession. And I think at that point, spreads rally back in, and you could have, a nice. If you're starting with a yield of 5.5%, you could maybe expect at least that return plus maybe another 1 or 2% on top of that.
Right. I'm also curious, kind of relating to that point, on a broader level. As you know, Tina has largely been the theme over these past few years during the ultra QE low rate period. But with the effective yield for AAA corporates now, 4 to 5%, would you say the Tina trade could largely be dead moving forward?
Well, I guess, that no longer holds, right? There is no alternative. There is an alternative. You can
Right.
actually get, a credit risk-free rate in the treasury market that looks pretty attractive at this point. I
Hmm.
would argue. I mean, if depending what your view is, you can, get anywhere between, 4 and 4.5%. Along the curve. I think that's pretty attractive. And then, if you do have a longer holding period, I think starting out with investment grades at 5.5% looks pretty attractive. You'd no longer have to take on excessive risk to get some sort of yield. So I think that acronym is dead for the moment, because there are alternatives. You don't have to take on that extra risk. So yeah, I think, we're starting from a much more interesting point in terms of all-in yields, both in investment grade and just with the treasury market. So I think that is definitely a shift. And, at some point we will start seeing money flow back into the sector. And, we started this conversation discussing about just how bad returns have been and how much outflow there has been in AUM in the asset class. But you have to remember that this asset class, the investment grade corporates, is very institutional, meaning that it's predominantly an institutional asset class. So
Right.
mutual funds are fairly small. I think, you don't get a completely clear picture, but there are estimates out there because there's a lot of investment grade corporates that go into ag funds. So if you try to aggregate all of that, something like 15 or 20% of the market is in mutual funds. And
Okay.
the other 80-85% is institutional money. So pension funds, insurance companies, those types of accounts are interested in all-in yields. And these type of yields are starting to look attractive to them. So I think that we will at some point start seeing an interest back in the market. I think what's going to be required there is less volatility. Um,
Right.
and that may be, a few months out, but at some point, the institutional buyer base will step in. And especially at these levels, I think it's starting to look attractive for them.
Right. And so, on the topic of volatility, as kind of financial conditions have continued to tighten, the Move index that measures volatility of bonds has been notably greater than equity volatility, at least for these past few months. But equity vol, as measured by the VIX, has really ramped up quite a bit over the past month since Powell's commentary at Jackson Hole. And so, although it seems like we could be well on our way to a major liquidity event if things continue continue at this pace. There hasn't yet been a, violent market-breaking liquidity-driven sell-off in credit. And so it seems like investors are still very much pricing in the possibility of this risk. And so how are you kind of analyzing current liquidity dynamics in credit and the effects of the boost in the Fed taper monthly cap now to $95 billion per month that's starting this month in September?
Yeah, well, I think it's all part of this extracting liquidity out of the system, right? It all
Right.
contributes to slower economic picture. It's everything we've been discussing, and I think that any kind of liquidity, that old saying, like, don't fight the Fed, is
Yeah.
been such a profound statement over the since really March of 2020, right? I mean, don't fight the Fed on the way where they're interested in putting liquidity into the system. We had, a massive rally. You look to see what happened in terms of equity price movement, in terms of spreads right after the Fed stepped in. I think it was like March 26th of 2020. And, that was a one of the sharpest snapbacks we've ever seen.
Right.
And that, we're seeing the exact opposite right now, where the Fed is committed to lowering inflation. And frankly, they should be. I mean, inflation is bad for everything in the economy, and it
Mhm.
distorts. There's many distortions that happen because of it, and they're committed to lowering inflation. We haven't seen these type of inflation numbers since the 1970s.
Right.
So this pulling out liquidity out of the system, whether it's with higher rates or selling securities that they have on their balance sheet. I mean, you're starting to see some of that happen in Europe as well. I think it all contributes to just more volatility out there, more spread volatility. I think, like I said, I think there is the chances of spreads going wider are greater here than they are going tighter.
Mhm.
But it really comes down to what your time frame is. If you're looking out over the next 3 months, I would say that the yield, that the all-in yield that you're getting right now in the investment grade corporate market is good. But spreads could go wider, so you could see some price declines. But if your investment horizon is 12 months out, I think investment grade corporates are a good place to be, especially starting with a 5.5% yield. And that's on the benchmark. Like I said, there are certain securities out there that are going to do better and that are offering a higher yield right now, that have better balance sheets. So as an active manager, I think you can go out and find things that are even more interesting than just the benchmark itself.
Right, that makes sense. And so, another interesting thing to note in the IG market is that it seems as though the broader composition of IG credit is getting weaker. And so I'm wondering if that's something that investors should keep an eye on, especially if the Fed continues down this aggressive rate path. And so, just for some context here for our listeners, since about 2012, there's been an increasing divergence within the composition of US IG credit. And so we've seen triple B rated corporates increase from about 35% of the market to now being 50% of the market, while double A and triple A's have fallen from 20% to just 10% of the entire market. And so, Monica, should we be worried that we're potentially going to see a flood of downgrades pushing them to junk in this cycle? And kind of what would you need to see to confirm that view of further deterioration?
Yeah, and I think, this is something we've been talking about for I don't know, 10 years now, I think, at least 7 years for sure. I mean, this whole migration, and your data is completely accurate. This whole migration and the investment grade corporate market looked very different 10 years ago than it did today.
Right.
It's much larger today. There are a lot more issuers than there were 10 years ago. And the issuers that have remained in the investment grade market and the new issuers have taken advantage of this low rate environment. And this has been, an active move on their part to raise super cheap capital. So, while before it maybe made sense to remain single A if your cost of capital was much higher, and especially moving down to a lower credit quality costs you more to raise funds, that hasn't been the case. And so companies have taken advantage of that, and there are many more triple Bs in the benchmark than there have been historically. And I don't think that means that we're going to see some large downgrade cycle. That the triple B space has remained fairly constant at that 50% over the last, call it 4 to 5 years. And again, it really has, this is something that companies have done actively to take advantage of lower rates. And the flip side of it is that it's actually been a positive for the market because they've tended to issue longer dated bonds. And so there isn't this issue of this kind of maturity wall to be addressed. So I'm not concerned about a broad downgrade cycle. But I do think at the margin, we have experienced over the last year and a half a fairly strong upgrade cycle. And I think that's for sure ending. And I think that there are specific credits out there that might find themselves in trouble if their cash flows drop significantly. For example, there are a couple of REITs out there that are relying on the market in order to sell some assets and bring down debt. And if the market's not open for them to sell down those assets and repay their debt, there could be a possibility of a downgrade there. But I think it's more very credit specific. I think the larger capital structures, AT&T is probably one of the largest capital structures in the triple B space, is in a fairly non-cyclical sector. And I think they've done, several large transactions, all committed to bringing down debt. So I think companies are very aware, especially the ones that have large capital structures, meaning they have a lot of bonds outstanding that they would have to refinance at higher rates, are very aware of not dropping down into high yield because their cost of capital goes up so much. So I think that these larger companies have many more levers to pull to remain in investment grade land. In fact, we've seen some of the larger capital structures that got downgraded, like a Kraft Heinz, go back into the investment grade space. And I think someone like Kraft Heinz is very interested in remaining investment grade. And so they're doing things to protect their balance sheet by having less share buybacks, by really focusing on their operations, by focusing on their balance sheet to remain in investment grade. But I would say, and I think we were discussing this on a separate call, I think you were asking me if there are, specific sectors that are going to do better than others. And I think kind of that's where this comes in, that there really are sectors out there that are going to weather better through this economic slowdown or recession than other sectors. And that's really what we're focused on.
Yeah, it makes sense. And so, let's get to the point of that and zoom in a bit into industry analysis within the market. And so, we've also seen signs of divergence of IG ratings across sectors. And so I'm wondering kind of which sectors do you think will be the most resilient, and conversely, which are going to see heightened stress in this period? And so presumably cyclicals seem to be where some of the largest risks lie. What other sectors would you avoid? And conversely, what sectors do you think are the most resilient to current pressures?
Yeah, well, and I think you hit on it. I mean, it's really cyclicals are the, the number one, I think, sector, anything that's really tied into the economy and economic growth is going to do less well than companies that are not tied into economic growth. And I would say anything that's kind of related to housing, I think that area is going to slow down. You're
Right.
already starting to see, real estate prices decline pretty significantly. I mean, I live in Jackson Hole, Wyoming right now, where real estate is absolutely obscenely expensive. But we've seen. I get Zillow updates, and saw a price decline on a $7.5 million house, price decline of $2.5 million down to 5. So pretty significant,
Wow.
price declines there. So I think anything kind of tied into that we're avoiding. And then there are some sectors that we've been avoiding for quite some time and unrelated really to what's going on in the economy, more related to what their market dynamics are and their kind of philosophy with their balance sheets. And pharma is one sector that we have been avoiding, and we will
Okay.
continue to be underweight. We think there's just a lot of event risk there. Pharmaceutical companies have been very acquisitive historically. They're very interested in shareholder returns, a lot of share buybacks there.
Right.
And they also don't offer a lot of spread to compensate you for that. So that's a sector that will continue to be underweight. Another sector I think to watch out for is a fairly new sector in our market. The business development companies, the BDCs, have been fairly active. This year, not so much, but up until kind of the volatility in our market, the BDCs were fairly active in issuing debt. And really, their underlying business is buying bank loans of smaller companies, weaker companies. So I think
Okay.
there could be some more volatility. And it's a fairly small sector, but I think there could be some volatility there. In terms of the sectors that we are overweighting, we still like US banks. I think that, from an equity standpoint, they may not be attractive, but from a fixed income standpoint, their balance sheets right now are pristine. They have a
Okay.
huge amount of equity cushion to absorb any kind of losses. And I think they basically at this point are just like regulated utilities. There's so much regulation there
Right.
because we just don't want to see what happened back in 2008 ever happen again. So the regulators have been very stringent with capital requirements with the bank. So from a fixed income standpoint, they look very attractive. And in addition to that, they offer a lot of spread. There's a technical reason why they offer spread. They tend to be very frequent issuers in our market, and they are a large part of our market.
Hmm.
So most investors are fairly full on banks when they come to market. So they have to come with fairly wide spreads compared to what an equivalent credit might offer. So we're happy to take that carry and feeling very comfortable with kind of the credit risk there. Some other sectors, I think kind of the obvious ones, the non-cyclical ones are like aerospace defense. Believe it or not, the rails tend to do very well when the economy is slowing. They continue to carry products, and they are fairly conservatively funded, and their balance sheets are fairly strong. That's
Okay.
another space I would say, to focus on. And then electric utilities. They definitely have some issues. I think California has some specific issues with the utility sector,
Right.
but there are some good electric utilities, and that is one of the least cyclical sectors that you can invest in. I mean, people need to keep their lights on. People pay their utility bills. And if they're operating within a good rate framework, they're able to pass along their costs. So that's another sector that that we're focused on. And then another large sector that we're just neutral on is energy. And that's,
Right.
we've seen oil prices fluctuate recently. And it's very difficult to have a strong opinion one way or another of where energy prices are going. So that's a sector where we just tend to be neutral and try to find the companies within the energy sector that we think are going to outperform.
Perfect. Very useful information. Well, thanks again for your time today, Monica. Really appreciate it. A lot of great insights that I'm sure our listeners will appreciate as they continue to try and navigate this interesting time within the markets.
Yeah, well, good luck out there, and thank you so much for having me. It's fun doing these, and again, thanks for reaching out.
Thanks a lot, Monica. Take care.
All right, you too. Take care. Bye.